Good morning. It's Monday, the 10th of March, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming as always from Mumbai, India's financial capital. The take, it's 5 years of the pandemic. It's now a full 5 years since the COVID-19 pandemic struck the world and changed the trajectory of our lives in more ways than one. The World Health Organization had declared the pandemic on 11th March 2020. That's tomorrow. Millions have died since then, and many, including some I know, carry the after effects of contracting the disease without a vaccine. It is a good time to ask if we've learned the right lessons from the crisis and whether we've got over the economic euphoria that characterized post-COVID recovery, and that's something that we are still staring at. COVID-19 locked us in our homes in a never-before way. The virus also saw a remarkable but coordinated response by the healthcare sector to come up with a vaccine at a timeline never seen before in history, helped also by the latest technology, including in software and AI. This period also saw massive fund injections by governments into economies, which in turn sparked inflation and then subsequently a wealth effect via the stock markets, particularly in technology in the US. Inequality has increased since 2020, with the world's richest 1% earning a bigger proportion of national incomes than before the pandemic. Interestingly, after the 2008 financial crisis, which also benefited a few, that is before the crisis hit, income gaps had reduced. The last 5 years have also seen an unprecedented digital participation leading to new channels of financial power in the markets, including in India. This has been accentuated by the app economy, which has led to unsustainable levels of speculation, consumption, and borrowings, and new fads, and even currencies like Bitcoin. The behavior change brought about by this period in personal consumption riding on top of inflation is something we are still grappling with and will continue to do for some time. For example, high inflation has been an issue in several major elections around the world, including in the major ones last year from the United States to India. A Reuters report says, fueled by post-lockdown spending, government stimulus packages, and shortages of labor and raw materials, inflation peaked in many countries in 2022. And then, after countries borrowed money to protect welfare and livelihoods, global government debt rose by 12 percentage points since 2020, with even steeper increases in emerging markets. Now, to fight all of this, central banks have been raising rates, as we know, while the United States and Europe have already started pulling back from them last year. India has done so only last month. Interestingly, India has the challenge of reducing interest rates without sparking another debt and borrowing frenzy. The larger point is behavior. We are still shaped in thought and action, perhaps, by the bull market times of the last few years, including the perception formed by the post-COVID bump we saw in consumption, which of course began flattening globally more than a year ago. Many believe that the heightened borrowing-led consumption and the financial market returns are here to stay, particularly if you're younger and came into the workforce in the last 5 to 6 years. Adjusting to the pre-COVID economy is not something we may desire. After all, who does not want to live in a world where we can continue to splurge on stocks and pizzas via slick apps that make us buy and consume usually more than what we want and can afford? And a rising stock market, which gives us the feeling that our wealth is growing even if incomes stopped rising meaningfully a few years ago. But gravity, like in all such occasions, tends to pull us back. And these are good moments to acknowledge the presence of it, even as we right-scale businesses and the consumption that drives them. We've already seen the stock markets pull back, accompanied by the tightening of loans and the slowing of growth in the companies and in the economy. And to wrap up on healthcare, the perception of the healthcare industry, quite fascinatingly now, is defined, at least in public eye, by the new innovations around weight loss and, of course, the companies that make them. Life-saving vaccines are now a distant memory, though do not forget that they were equally instrumental at that time in driving up stock prices, at that time again of pharmaceutical giants like Pfizer, Moderna, and AstraZeneca. And the United States, under the Trump administration, has now said it is pulling out of the World Health Organization, an organization it feels did not anticipate or do enough to manage the pandemic. Life seems to have come full circle. And that brings us to the top stories. And remember, this is a holiday-shortened week. The market saw their best week in 3 months. Where will they go next? The dollar is weak and the rupee and oil are steady. Large gold shipments continue to move around the world on fear of US import tariffs. Why are Indian consumer product distributors taking quick commerce companies to the Competition Commission? And Bill Gates recommends reading this book to fight food shortages.
This is a Core Report with Govindraj Ethiraj.
Will the market recovery continue? The Nifty 50 posted its best week in 3 months, thanks also to re-rated stocks like Reliance Industries. The Nifty rose about 1.9%, close to 2%, its best in 3 months, while the Sensex gained about 1.6% and logged its highest weekly gain since January end. All of this was last week. Foreign investors, on the other hand, continue to sell consistently around $2.8 billion in the first week of March. If they are selling, who is buying, you might rightly ask. Obviously, domestic funds and investors, as analysts have been pointing out, because domestic funds are still seeing inflows and they have to get back into the market at some point. There is a contrast though. While Indian markets are down over 14% since their peak in September 2024 and technically a good time to enter again, for investors who are watching valuations, they still seem high. A report in Bloomberg points out that overseas investors have pulled about $15 billion from local shares this year, putting outflows on track to surpass the $17 billion record in 2022. The sell-off has wiped out about $1.3 trillion from India's market value. India's benchmark Nifty 50, however, is trading at 18 times forward earnings, compared with 21 times in September. But despite that drop, Bloomberg points out that the market's multiple remains higher than that of all its emerging Asian peers. Picking up on that earlier point of a post-COVID normalization, India's economy will grow at a 4-year low of 6.5% in the current fiscal year. So foreign investors could take some time to come back, though the bullish calls continue, including Morgan Stanley, which pointed out once again that the number of affluent Indians is rising. According to an analyst who spoke last week, the middle class in India will go from 70 to 170 million in the next decade. And more importantly, 20 million Indians will move into the rich category. So these iPhone and luxury car consuming individuals will drive top-end consumption, which of course they already are. And all of Apple's incremental revenue growth in the last 2 years has come from India, the Morgan Stanley analyst said, adding that energy consumption in India per capita is also rising as it goes from 800 watts to 2000 watts, which will drive India's growth story. Looking at my electricity bills, I can surely testify to that. All of this does not mean FIIs are returning right now. So the good news is that as it happens in these kinds of times, the Securities Exchange Board of India wants to work with all institutional investors, domestic and overseas, to address their issues. SEBI's new chairman, Tuhin Kanta Pandey, said at a money control event last week. High capital gains tax rates on foreign investors has been suggested as one bugbear or problem. Of course, that can now help only attract, but cannot be the only reason. Investors invest in India because despite all these challenges, including higher tax rates, the returns are worth it. If the returns are being questioned, at least in the near term, then no amount of tax incentives or lower taxes will help, because that's not how investment calls are made. Though it is always nice to hear a regulator to speak of the importance of long-term capital and a conducive environment to encourage foreign investments. And that, at least in my mind, is a good stage to set for the near future. The rupee weakens. The Indian rupee weakened slightly on Friday, but more importantly, the dollar is weaker now, hovering close to a 4-month low against its major peers. The rupee was at about 87 rupees 14 paise against the US dollar, down slightly from 87 rupees 11 paise in the previous session, according to Reuters, which also pointed out that Asian currencies were mostly range-bound, while the dollar index dipped below 104 at its closest or closing into its weakest level since November. Gold continues to move around. There is a massive amount of physical gold still moving around the world. The latest is Australia, which has shipped a record amount of gold to the United States in January as fears of potential tariffs saw traders rush to deliver metal into New York warehouses, according to Bloomberg, adding that those exports added to about $2.9 billion in the month, the highest amount in records dating back to 1995, according to the Australian Bureau of Statistics. Gold, of course, is moving from many other countries and regions too. Australia typically exports to countries closer in proximity throughout the Asia region, but the recent turmoil in global precious metals markets has disrupted normal trade flows at a time when prices were already near all-time highs. There are continuing fears that US President Donald Trump may slap tariffs on gold imports as well, creating unusually large and persistent premiums that incentivized imports to the US, according to Bloomberg. China goes into deflation. China is on track for the longest streak of economy-wide price declines since the 1960s as a result of weak spending, according to Bloomberg. China's consumer inflation dropped far more than expected to fall below zero for the first time in 13 months, a sign of the deflationary pressures persisting in the economy. The consumer price index has declined to 0.7% from a year earlier, according to China's National Bureau of Statistics, compared to a 0.5% gain in the previous month. Even when adjusted for the effect of an earlier than usual Lunar New Year holiday, consumer inflation slowed to amongst the weakest levels in months, according to Goldman Sachs, quoted by Bloomberg. China's core CPI, which excludes volatile items like food and energy, decreased for the first time since 2021 with a drop of 0.1%, only the second time that gauge has contracted over more than 15 years, according to Bloomberg, which also added that factory deflation has extended now into the 29th month. Consumer product distributors are up in arms. Last week, fast-moving Consumer Goods Distributors Association, the All India Consumer Products Distributors Federation, filed a petition with the Competition Commission of India against leading quick commerce platforms, alleging unfair pricing and monopolizing the market. That plea was submitted by Dhairyashil Patil, president of the AICPDF, who will join us in a moment. Quick commerce and hyperlocal delivery has become very popular in the last few years. The word quick commerce also defines fast and efficient delivery services, according to that petition, which said that quick commerce companies are indulging in practices of deep discounts and exclusive supply distribution agreements, engaging in unfair pricing and affecting the competition in the market for selling consumer goods. It says that practices are negatively impacting livelihoods of over 10 million mom and pop stores, as well as the operations of super stockists across the country. Now, there is no doubt about predatory discounting, as several analysts have spoken on the core, particularly from the supply chain industry. But the question also, I guess, is that what are the inefficiencies in the traditional system that exist, which are manifested in higher prices, and could that be, or to what extent could that be brought down? So I reached out to Dhairyashil Patil and I asked him to break it down for us and explain why his body was going to the Competition Commission and what they expected to achieve.
So the impact is on multiple folds. Okay. Deep discounting and predatory pricing is the result of this entire thing. Because nowadays, if you see anything people or the consumers buying online needs to be discounted. You will hardly find any example where people will buy goods from the quick commerce or e-commerce without any discount. So the consumer is being fooled in number of ways and numerous ways. The algorithms used by all this quick commerce and all this e-commerce entities is actually not been used to the advantage of the consumer. See, in the algorithm, consumer is convinced in such a way that he is convinced and preconditioned at his mind that the product which he wanted to buy once or he searched once, he's been shown numerous times and he's been preconditioned to buy that product. Now, this is one thing which is hurting the entire privacy of the consumer, first thing.
This is more a behavioral thing, isn't it?
Yes, absolutely, absolutely. Because see, now the quick commerce is banking on convenience. That is why I wanted to put this point that the convenience is not only the matter. There are a lot of things where the consumer is also been confused. See, discounting is a major part. Without a discount, consumer will never buy from these quick commerce companies. Right now, they are subsidizing delivery cost, which also the consumer will not be very happy to pay if they are being charged. Simple example, as you asked, what is the problem? Let us not name any company. Okay. There's a product of 1 kg product whose MRP is 710 rupees. Okay. Now we have searched about 100 products like this, similar who are having issues. The MRP for all these products across the platforms, you come what say the general trade or the quick commerce or the e-commerce platforms, the MRP is same. Okay. Now, 85 to 89% of the goods for all the FMCG companies are being sold by the general trade. Okay. Now, the general trade is being serviced by the authorized distributors of the company. Now, the retailer, that is the general store, what we are talking, receives this product at 657 rupees from an authorized distributor of the company. That is an extended arm of the company. So, for the retailer, the distributor is the company. Now, the same product is sold at 469 rupees on Zepto. It's sold at 554 rupees on Blinkit, and it is sold on 461 rupees in Instamart. Now, this retailer, who is big in number, is getting this price as his landing cost at 657 rupees. How can he compete with all these people? See, a lot of us are telling us that you will have to adopt technology and changes everything. See, everybody wants to clean Ganga, but you'll also have to remember you have to have Himalaya in place. If there is no Himalaya, point of Ganga won't be there.
If I can ask you about this specific product, and if you're saying that these quick commerce companies are selling it at 469, 554, and so on, what is their acquisition price? Are they buying it from the same distributor, or are they sourcing from the company, for example?
They are mostly sourcing it from the company. We will have to find out. That is why we have went to this authority, which is a CCI, and we have full faith on our judiciary system that they will find out whether the companies are giving this kind of discount or whether these quick commerce are putting in money for deep discounting and predatory pricing to establish monopoly in the market.
But who do you feel is discounting in this particular case? Do you feel the company is offering it, let's say, at 450 rupees, or is it the quick commerce company which is taking a hit?
See, the companies believe into the retail trade because it is an absolutely loyal network to them, which the companies have been establishing since last 60 to 70 years. We really doubt whether companies are giving such kind of heavy discounts to them. And if the companies are willing or are giving such kind of discount, then we will also rightfully ask them to give that prices to us also. Clear cut case of deep discounting and predatory pricing, which is trying to establish a monopoly into the market and disturbing the entire ecosystem.
Right. So one is the price. Now, this is also a different distribution channel, isn't it? When it leaves the company or the brand, let's say it's Levers or Nestle or Colgate, it's going directly maybe through logistics partner directly to a dark store, and then it's being distributed. Whereas in your case, the way it comes to the Kirana store is a different path, isn't it?
No, sir. This is absolutely a myth created by these people that they are taking out the middleman from the entire chain. They have done nothing. See, in general trade, the company depot supplies to a distributor, and the distributor supplies to a retailer, and forward, the retailer supplies it to the consumer. This is the traditional distribution system. In quick commerce, the company supplies to their mother depot, the mother depot supplies to their dark store, and the dark store supplies to the consumer. Now, tell me, where is the middleman gone? His name is only changed. The name is changed from distributor to mother depot, from retailer to dark store. So the process is absolutely same. Just by changing the name, they cannot say that they are more efficient than the distribution system. The distribution system in India is covering 13 million outlets across the country, and farthermost, even in Leh, Ladakh, you will find Maggi noodles supplied by a distributor and serviced by the retailer. So you have also seen at the time of pandemic, where were all these people? That time, the retailer was there on the street serving the Indian public.
There's no quarrel on that, but I think the debate here is to do with, since you've complained to the Competition Commission, we're talking about price and whether there is discounting or not. So you're also saying that therefore, when the company is supplying to a mother depot, as you call it, and mother depot to dark store, you're saying that that chain is not cheaper or more cost effective than the older chain?
Absolutely not. See, the distribution and networks chain, whatever is supplying right now, the average margin of a retailer is from 8% to 12% across all companies. Average margin for the distributor is from 3% to 5%. So the all put together is what you can say about 20%, and rest is the logistic cost. Now, it's not that the logistic what we are providing, because we have our own vehicles. The cost of logistics are very low. The labor which we employ, the cost of labor for us is also very, very low. The godowns, the infrastructure, whatever it is almost owned by the distributors. That is why the rental part is also very low. So our cost of operation is very, very low. Our cost of distribution is average 1.3% per average cost of distribution. Here they will have to pay 5% GST on transportation because they are applying numerous plus things. So all of these things put together cannot be cost effective, and in a long run, this model I don't want to say anything about it, but when a business is on a transactional loss, how can you justify it to be a operational profit?
So at this point of time, you've complained to also the FSSAI, that's the Food Safety and Standards Authority of India, and you've questioned or rather posed a question on shelf life. Why is that?
See, we have found on number of cases and done a survey with the consumers where the consumers been receiving products with very, very minimal shelf life receipt. See, I've received a product which is going to be expired in 2 days. So I am compelled to use a product which is going to be expired in 2 days. So it was found that most of the consumers were receiving food items to near to expiry dates. We are very much thankful to the Ministry of Health and the FSSI department who has brought out a notification on our suggestion that consumers should receive the product with minimum 30% shelf life available or 45 days, whichever is higher.
Right. Okay. What is it that you're looking for right now? So in the beginning, you said that you want more transparency on the pricing, including from the companies themselves. Is that your key demand, at least from the CCI?
Sir, we are Indians and we always will be Indians. See, we are not afraid of any competition. See, we just want a fair playing field. We want a level playing field for everybody. Then we also can compete. See, the deliveries right now done by the retail system, which is existing there, is at least 10x of whatever all quick commerce is doing. So we can service, we know how to service. We have been servicing the population since ages, and our service is more emotional than professional.
Dhairyashil, thank you so much for joining me.
Thank you.
Bill Gates highlights a new book and a solution to fighting food wastage. Bill Gates has recommended reading author Vaclav Smil's book on how to feed the world. He says it will transform the way you think about hunger, food, and what we eat or don't. In his Gates Notes blog, he writes that in the introduction to his latest book, How to Feed the World, Smil writes that numbers are the antidote to wishful thinking. Gates says the Canada-based Czech academic, across his decades of research and writing, has tackled some of the biggest questions in energy, agriculture, and public health, not by making grand predictions, but by breaking down complex problems into measurable data. Gates says that many discussions about feeding the world focus on increasing agricultural productivity through improved seeds, healthier soils, better farming practices, and more productive livestock, all of which are priorities for the Gates Foundation. Vaclav, however, insists we already produce more than enough food to feed the world. The real challenge, he says, is what happens after the food is grown. And the numbers tell a striking story. Some of the world's biggest food producers have the highest rates of undernourishment. Globally, we produce about 3,000 calories per person per day, which is more than enough to feed everyone. But a staggering 1/3 of all food is wasted. In some rich countries, that figure goes up to 45%. So distribution systems fail, economic policies backfire, and food doesn't always go where it's needed. Gates says that like all of Vaclav's best books, it challenges readers to think differently about a problem we thought we understood, adding that growing more and better food remains crucial, especially in places like sub-Saharan Africa where there simply isn't enough. But Gates says that as the world's population approaches 10 billion, increasing agricultural productivity alone won't solve hunger and malnutrition. We also need to ensure that food is more accessible and affordable, less wasted, and just as nutritious as it is abundant. After all, says Bill Gates, the goal is not to make more food for its own sake, but to feed more people. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.